name is Vin Joya, and I'm here on behalf of Anchin, along with my colleagues, to give you a brief overview of ASC 326 current expected credit losses. This is the second video of this series, so you may want to watch the first video as it provides some important background into the topics I'm about to discuss. Please note that this is intended to be an introductory course and has been prepared for informational purposes only. It is not intended to provide and should not be relied on for tax, legal, or accounting advice. Before making any decision or taking any action, you should consult a professional advisor who has been provided with all the pertinent facts relevant to your particular situation. In this video, we'll be covering the process for calculating your CECL reserve, along with the related financial statement disclosures. The first step in developing an allowance for expected losses is to form pools of financial assets that share similar risk characteristics. Some common characteristics that can be used to establish these pools are public versus private customers, aging of receivables, ratings from credit agencies, internal or external credit scores, risk rating or classification, customer size, project type, industry of borrower, or geographic location of the customer. There are many other characteristics that can be used for this analysis, as long as there is a reasonable justification for doing so. One important item to point out is that the expectation would be for it to be relatively uncommon to only have a single pool. Similarly, it's not expected that there should be an exorbitant amount of pools either. These pools will be subjective and will be varying on a company-by-company basis. After the company has established their pools, they should estimate the loss for each pool. Some common credit loss methodologies include loss rates, weighted average remaining maturity, probability of default and loss given default, and discounted cash flows. In using these methodologies, the company should be considering past, present, and future factors to evaluate both qualitative and quantitative factors. These past factors should evaluate historical loss rates for each established pool, while making sure that the historical period analyzed is representative of the current conditions. The company should also consider present factors such as rising interest rates, declining property values, rising unemployment, rising customer delinquency rates, or industry downturn. These are just a few of the potential factors that could be at play when establishing your loss rates. Lastly, the company should be considering future factors by developing a reasonable and supportable forecast for the entire contractual term of the underlying assets. The interpretive guidance has established a pretty high bar for any zero expected credit losses, meaning that a reserve of zero is considered to be very unlikely. That said, not having a zero balance does not mean that the reserve has to be significant or material. As with any new standard, the required disclosures are in the transition. However, the purpose of this video will be touching on the disclosures required by the standard itself. The overall disclosure objective of ASC 326 is for entities to provide the users of the financial statements with useful information in analyzing an entity's exposure to credit risk and the measurement of credit losses. As a result, the disclosure requirements within ASC 326 are significant. The disclosures include qualitative and quantitative information about the allowance for credit losses, the company's methodology for determining its allowance, the amounts recognized in the financial statements, the write-off policy, which the company may have to develop a formal policy for, and a detailed reconciliation of opening to ending credit loss reserves. It's important to note that the required disclosures are extensive. We will be providing links to resources that will provide further guidance on the required disclosures. Lastly, as with any disclosures, and in particular those related to this new standard, if your Anchin partner will be assisting you in preparing these disclosures, they will be providing them to you along with a disclosure checklist for your review and approval. Here are the resources that can be of additional assistance for you and your company. There's a lot of information here, and we recommend that you reach out to an Anchin advisor on a detailed calculation of your CECL reserve and the related disclosures. Please be on the lookout for additional videos from the Anchin team to assist you as you adopt the new CECL standards.